Why do some people retire with financial freedom and others struggle and scrape just to get by despite making similar income before retirement? This is a question I've been working on since 2010, come up with some answers, and now I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hello, everyone. My name is Brad N. Reed. I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Welcome to the Financial Fountain of Freedom. Today, we're going to talk about options and especially the Greeks and some advanced strategies. Those two advanced strategies I'm going to talk about how to sell insurance, aka credit spreads, and how to win if the market moves big in either direction. That one's called strangles. I will mention straddles, but strangle is the version I prefer. Then next week, I'm going to finish up the stock trading series with fundamentals and portfolio construction. And then July 1st, we'll jump into the introduction to multifamily real estate. The reason I start with stock trading stuff is that it's open to everyone, whereas real estate, it is available to everyone, but it's a lot harder if you are not accredited. All right, I am building a 4-tier offering where tier 1 is about how to get out of debt. That's why I say be good. GOOD stands for get out of debt. That's going to be the financial fundamentals. Number 2 is mind, body, and spirit. I don't talk a lot about mindset in this investing section, but your mindset determines your future. And so your mindset about money will determine your financial future. And one thing I want to share with you is that your identity, how you identify as yourself, is the strongest force in the human system, is to be consistent with your identity. So there was a study where they took a group of college volunteers and they told them that they were going to have the best sleep of their life and bring your favorite pillow, bring your favorite blanket. We're going to give you some chemicals that are going to make you sleep, and you're going to sleep for a really long time. It's going to be deep sleep. So enjoy this great sleep. But instead of giving them sedatives, they gave them speed. They gave them the maximum dosage amphetamines that they could legally give them. Shockingly, instead of being awake and tossing and turning all night, these students slept extremely soundly. And then they tried the opposite. They brought in these kids. They said, hey, bring your study materials, bring your favorite music, bring your party clothes, bring your workout gear. You are going to be awake for days and days and days. You're going to have the most amount of energy. So whatever is important to you, whatever you want to get done, you are going to get it done. And they brought these kids in and they gave them the strongest sedatives, barbiturates that they could give them legally. And the kids had a wild, crazy party, working out. Some studied, some read, but they did not sleep the entire night. So the point is that regardless of what drugs you take, what you believe is what will happen. This is also known as the placebo effect. So what is your mindset telling you? What is your mindset guiding you? Get control of that. The mindset is going to be the strongest force of anything that I can teach you here. All right. Today, we're going to be talking about investing for success and how to build multiple streams of income so you can achieve your financial dreams. And then tier 4 is about how to live those dreams, how to give generously to your community, how to do what you want when you want, how to keep the money going, and how to not outspend your streams of money. Before I go any further, need to do the disclaimer. This presentation is for education and entertainment only. There is no advice given here. Should you want any kind of advice, like investment advice, tax, accounting, legal advice, you need to seek a competent and licensed individual in your area. I might be talking about securities that you can buy or sell, but there is no offer to buy or sell, nor is there advice or recommendations to buy or sell in this presentation. All right. If you are going to build your financial fountain of freedom, like I am building, your money mindset will determine your financial future. Get right with your mindset. If you ever go to the bookstore or do a search for books on investing, you will note that at least half of these books are only about the mindset. I encourage you to calculate your desired rate of return. Remember, inflation, at 4% inflation, the cost of living will quadruple in a 36-year period. So a lot of people get in trouble in retirement because they want to be on fixed income. Fixed income can mean that the amount of income does not go up as the cost of living goes up. And that's how many people get themselves in trouble during retirement. Fortunately for you, I have created an inflation adjusted retirement calculator. Hey, Bijan, guess what? I figured out how to link this stuff so I can put it in the chat pane a lot easier. So I put it in the chat pane. If you're watching this recording, it will be on the it'll be in the description. So go find that link to the inflation adjusted retirement calculator, and then you can determine what is the rate of return that you need. Once you know the rate of return that your family needs, you can structure a portfolio that will achieve that rate of return. Ray Dalio suggests you get investments that are diversified, non-correlated, with asymmetric risk reward. If you do not know what that means, go back to episodes 1, 2, and 3. I talk a lot about that. And Peter Mallouk advises that, or at least his high net worth individuals, have most of their money in real estate because it is solid, it gets a good return, and there's a lot of tax advantages. The second highest asset allocation can be private equity. Now, private equity has a lot higher reward, but there's also a lot higher risk. For example, I've talked about a paving business that I invested in. Well, guess what? That thing has failed. The operator of the fund that I invested in actually got very sick and is stepping down. And myself and the other investors were given the choice to vote. Do we get our money back, or someone else that we don't know anything about would take over the investment and our financial future? Because we didn't know who this person was or their track record or anything like that, we all voted to get our money back. So I will be getting my money back. But just for transparency, that paving business that I talked about a couple of episodes ago, that investment is over and I'm getting my money back, but no growth. All right, moving on asset allocation. 15% of your wealth could be in public equities such as stocks, 10% in energy, and the rest in alternatives. That would be 5%. But you choose what you need for you and your family and what you need to get your desired rate of return and your needs for cash on cash or equity growth. Indomitable Horizons Funds has investments that are open now. So if you are an accredited investor and are seeking something outside of the stock market, swing on over to indhrs.com and see what we got. Excuse me. All right. Final warning. If you are trying to learn a skill, you will only get 10% of what you need to develop that skill by reading and listening and watching videos like this one. 30% of developing a skill is by discussing with others, preferably coaches and people that have developed the skill already. And then 60% is by actually doing it. So think about learning how to ride a bike or learning how to swim. You are not going to learn those skills by reading a book or watching a video. All right, we are almost done with the stock market education. July 1st, we're going to jump into multifamily knowledge. On this coming weekend, June 12, 13, and 14, a couple of us are going to attend a stock trading webinar together. If you want to get in, hit pause, follow the instructions on the bottom of the screen. If you want to email me, I can try and get you in our group at this webinar. But the plan is that those that did register ahead of time and sent me your information, we will be attending together and trading together. All right, key terms. Remember, an analyst is that person that is less regulated than your stylist at Supercuts. They can write pretty much whatever they want, whenever they want. A brokerage is where you go to buy and sell. They will execute orders on your behalf. This referral link, I'm putting it in the chat pane. If you click on that, it will take you to this page where you can, you can enter in your information and you can create an account. And if you fund it, they will send me just a little bit of love. Let's see, that's the inflation adjusted retirement calculator. I'm going to turn that one off for now. Oh no, I hit the wrong button. All right, let me pause the video and I'll get this. All right, going again. So yeah, just share the referral code. This will be also in the description if you're watching this YouTube recording. Remember, the exchange or where the market maker resides, where stocks and options are bought and sold. And I was talking to a trader not too long ago, and I think it was Tesla that they were talking about trading. And they said, hey, I got something that says I can trade it on the NASDAQ or the Toronto Stock Exchange. Since that investor was in the USA, I said, pick the NASDAQ. So trade in your country if you can. The market maker is a firm that stays ready to buy or sell at any time. You need to understand how the market maker works. The buyer buys stocks or options, and when they buy, they pay the ask. Today, we're going to talk about options trading and how you can get a better price at the ask. If you're doing stocks, you will pay the ask. If you are selling stocks or selling options, you will receive the bid. Similarly, with options, you can get a better fill than the bid. But you will buy the ask, you will sell the bid. The market maker keeps the difference. That is called the bid-ask spread, and that is the profit for the market maker. It is extremely important you understand how that works. All right, I'm going to go fast. And I think maybe in the future, I'm just going to skip these reviews. If you need the review, go watch the previous episode. If you're trading stocks, use candles. You get a whole lot more information on candles. I prefer white and black candles, white for bullish, black for bearish. But with my trading software, which is Thinkorswim, they don't show up that well. So I use green and red. Study the wicks. The wicks will tell you what happened during that trading session, whether it's a day, a minute, an hour, a month. The wicks can tell you who is winning, buyers and sellers, and can give you clues on which way it will go next. You need to create a trading plan. A trading plan is a set of rules on what to do before, during, and after every trade. I will be giving you trading plan rules today. Hopefully you have your trading plan set up. There are 4 phases to creating or to validating your trading rules, to testing them. So make sure you have tested your rules with fake money, with a little bit of small money before trading live with the full risk unit. And R is your risk unit. Be sure you know how to limit your risk and how to calculate the number of shares so that if your trade does move against you, that you do not lose more than your planned risk unit. All right. I have created a trade journal if you choose, if you want it. It's a good place to start. Remember, go to File, make a copy, and File, make a copy, and then you can change it however you want. And if you mess it up too bad, just come back to that link and get a new one. All right, options were designed as insurance. A put is insurance on a stock that you own. A call is insurance on a stock that you are short in. That's what it was designed. We can use these options in various ways to do other things, but that's what they were designed for. If you intend to trade options, you need to talk to your broker and get approval. Because if you do options wrong, you can lose a significant amount of money very quickly. So the broker will restrict on what types of options you can do and what types of accounts. Short story, call your broker and tell them what you want to do, and they will likely issue you a test of some sort, and then give you the appropriate options approval rating. All right, there's basically 4 things that we can do with options, and we can do these in various patterns, various combinations. One of them is with calls. You can buy calls. A call option is the right to buy 100 shares at the strike price before it expires. If you buy the call, you receive the right and you pay a premium. typically the ask, sometimes lower. You can also sell calls. And if you sell calls, then you are obligated to, to guarantee the contract that whoever bought it has. So they have the right to buy shares from you. So therefore, you are obligated to sell those shares at the strike price if the person that owns the option chooses to do so. So you are obligated. You do not have any control whether or not you have to sell your options. For taking on that obligation, you receive a premium, typically the bid, sometimes better. On the puts are the right to sell 100 shares at a strike price on or before expiration. And if you want that right, you have to pay a premium. You can also sell puts and give someone else the right to sell you their shares. So therefore, you take on an obligation to buy 100 shares. You take on the obligation. And when you take on that obligation, you receive a premium, typically the bid. When you sell stuff, you receive a premium. When you buy stuff, you pay the premium. So one thing we talked about is buying puts as insurance on stocks you already own. If you buy a put, you have the ability to sell 100 shares. If you don't have 100 shares, that's fine. You can sell the shares that you got, or you can sell the put. If the stock price goes down, the put value will go up. You can sell puts on stocks that you want to own. You receive a premium when you sell that put. So if the stock does not drop to your buy price, you just keep the premium and you do it again the next month and you keep doing it until the stock drops to your buy price. Be sure you have the money to buy 100 shares, because if the stock does drop to your buy price or below, you will be buying 100 shares at the strike price. Be sure you have that money ready to go. If you own stocks, you can sell calls against stocks you already own. That's called covered calls. So if you own 100 shares and you were waiting for it to go up to a certain price, you can get paid by selling the calls. That gives someone else the option to buy your shares from you. And you receive a premium for taking on the obligation to sell your shares if the other person chooses. So you get paid every month until the price goes up to the strike price. So if you're waiting to sell at your price, you might as well be getting paid every month. And then we can lock in your gains by buying a protective put. This protects your downside. And you can sell a covered call that allows you to sell at your target price. So if the stock price goes up, you will sell your shares at your target price that you wanted to sell at, and you'll receive a premium for that. You will still own the protective put, and the protective put protects your downside. But if you sell your shares, the put might still be worth something if it goes down. If the stock price reverses and goes down, your put will go up in value. Or the stock price goes down, you use your protective put. Be sure you exit your covered call. It will be worth zero, but call your broker and see if you can close it out. Sometimes you have to pay a small commission, but you do not want to have a short call if you do not own the shares. That's called a naked call, and it carries a lot of risk. All right, options. The value of options is calculated. It is not random. It used to be random, and some people were getting filled at wildly different prices from their friends that were buying the same option that same day or selling the option for the same day. So I don't need you to remember or memorize or know what this calculation is. Just know that there is a calculation for the price of the option. One thing that goes into the calculation is the risk-free interest rate. It's called rho. No one ever looked, well, I don't use it in any of my formulas or any of my stock trading. You can't control it, but it's there. Gamma is also something that exists that I do not use in any of my formulas. Gamma is just how fast delta changes. We're going to talk about delta next. But again, rho and gamma exist. I do not use them in any of my formulas. I don't know of anyone who looks at them on a regular basis. The delta curve, delta is how fast the value of the option will change per $1 change in the stock price. So as you can imagine, if you own a call, as the stock goes up, the value of your option goes up. But the question is, how fast? So at a delta of 0.5, if this underlying stock price goes up $1, your call option will go up 50 cents. If you have a put at a delta of negative 0.75 and the price of the underlying stock goes up $1, the value of your put will go down 75 cents. So the delta tells you how much your option price will change per $1 change in the price of the stock. So calls go from 0 to 1. They are always positive because as the stock price goes up, your call option should go up. Puts are negative because as the stock price goes up, the value of your put goes down. Or as the stock price goes down, the value of your put goes up. Delta changes the most at a delta of 0.5 or negative 0.5. That's considered at the money. Remember from last time, at the money is when the strike price of your option is equal to or very close to the underlying price of the stock. Excuse me, the price of the underlying stock. Keep a mental note of these curves. They are very important. Notice the inflection points of 0.25 and 0.75. If you are speculating and you want to buy a call down here at 0.25, if you are right, the delta, the value of your option, should increase very quickly. If you are wrong, the option price will decrease very slowly. Similarly, if you buy something in the money and you were right, the value of the option will change more slowly. However, if you have an in the money option, the delta will dominate the value of your option. If you are out of the money, Theta and Vega will dominate the value of your option. We'll talk more about that later, but just notice the curve, right? Notice the curve. So 0.8 to 9 is where risk-averse buyers tend to buy options if they want to trade options directionally, thinking the price of the stock will go up. They may buy a call around 0.8 or 9, but certainly above 0.75. If they're buying a put because they think a stock's going to go down, they'll buy it around the delta of 0.8 or 0.9 because it moves predictably with the stock. And yeah, Vega and Theta have less effect. I talked about 0.25. If you're right, it gains delta very fast. If you're wrong, you lose value of the option very slowly. This is with the call and the put on top of each other. Some people use delta as the probability. Mathematically, that's not what it is. But sometimes you can look at the delta and equate that, use that as an estimate of the probability that an option will expire in the money. So if you have a 0.10 delta, that's obviously a call because it's positive, but that means that that call option will have about a 10% chance to be in the money at expiration. So that might be something you want to sell if you want your option to go to 0. At a delta of about 0.25, you have roughly a 25% chance of the option to be in the money at expiration. At delta of 0.5, remember that's at the money, basically a 50-50 chance if the stock's going to go up or the stock's going to go down. 0.75 gives you a roughly 75% chance that that option expires in the money, which is why traders that are trading a stock directionally, they might use an option around a 0.8, 0.9 delta. Sometimes if it's a really expensive stock, traders would rather trade the option price than the stock price. Because if a stock is $1,000 and it goes up $1, then that's a 0.1% move in the value of your investment. but maybe you bought the option for $100, and therefore a 1% move in the stock price might have a 0.8% move in the value of your option. All right, lots of numbers there. This is why it takes a while to develop this skill. All right, 0.10 delta gives you a 10% probability, a low probability of finishing in the money. 0.5 delta is about a 50% chance of being in the money at expiration, and 0.75. Okay, that is delta. Theta is the time decay. All I want you to know here is that when the option gets close to expiring, theta drops off a cliff. That means that the value of your option is going to drop very quickly as it approaches expiration. So if your option is out of the money, you will see it go to zero quickly. If it's in the money, again, delta controls the value of your option. So, exercise it, figure out what you want to do with it, exercise it or sell it, but you will not experience the theta decay. So if you are buying options, you typically want to buy a lot of time because the theta decay is very slow when there's a lot of time. If you are buying options, you want to buy a lot of time because theta decays very slowly when there's a lot of time. If you are selling, you typically want 30 days or less because the theta will bring the value of your option down very quickly. All right, moving on to Vega. Let's see, I'm looking in the chat pane. Yep, nothing in the chat pane. Yeah. Vega has to do with how the implied volatility affects the value of your option. So technically, for every 1% move in implied volatility, Vega will affect the price of your option. Now, here's the kicker. Implied volatility is determined by the market maker. Implied volatility is determined by the market maker. You know, if option prices are calculated, that the market maker has to have their advantage, right? That's how it works. Well, implied volatility is their advantage. Effectively, it's what the market maker anticipates will happen in the future, but they can set it to whatever they want to make it work in their favor. Just know that when implied volatility goes high, gets big, options become expensive. That's a good time to sell. When implied volatility is low, options become cheap. That's a good time to buy. All right, so buy when implied volatility is low, sell when it's high. And as you can imagine, Vega is highest on longer term options. Why? Because the more time you have, the more chance there is for something to come in and make that stock get volatile. So when implied volatility is high, it's a good time to sell. When implied volatility is low, it's a good time to buy. And these are the strategies for buying. One thing to remember is that a lot of times, not a lot of times, some of the times, a market maker may have to take the other side of your option. In stocks, all of the market makers are computers because they go really fast. Most of the market makers for options these days are computers, but some are people. And it wasn't, 10, 15 years ago when they were all people. And yeah, if you wanted to buy an option, sometimes the market maker had to decide if they were going to take the other side or not. If Bijan wanted to buy an option and I wanted to sell an option, they were real happy, right? They were going to, I would sell it and Bijan would buy it and the market maker just makes their bid-ask spread. But if Bijan wants to buy an option and no one wants to sell it, the market maker has to take the other side. And that means the market maker has risk. If Bijan wins big, the market maker has to pay out of pocket. So that's why the market maker can control the implied volatility and they can monkey with the bid-ask spread. So we talked about if implied volatility is high or low. How do we know if it's high or low? We can compare it to historic volatility. We can also compare implied volatility to what it has been in the past. So again, if it's high, options are expensive, sell. If it's low, buy. So here is a chart of implied volatility versus historic volatility. Tell you what, let's just make this bigger and go look at it. And I will copy that and put this in the chat pane. This link will also be in the description if you are watching this recording. But if you scroll down a little bit, this is where it will appear on the page. This is free. And yeah, I'm not even logged in. So thank you, barchart.com. Props to you. Blue is the historic volatility, what has happened in the past. And the yellow or orange here is the implied volatility, what the market maker is setting for the future. Take a look, this blue chart down here. Can we turn that off? Oh, great. These blue squares are earnings announcements. Notice before earnings, implied volatility goes up. There it went up super fast. Over on this earnings, it went up very slowly, but it went up for a really long time. Before earnings announcements, implied volatility tends to go up. Why? Because earnings can be a volatile event for a stock. Now notice after an earnings announcement, implied volatility drops really, really fast. Every single time, implied volatility drops really, really fast after earnings. If you are buying out of the money options, this drop in implied volatility can destroy the value of your option, even if the stock moves in the direction that you want it to. So what I'm saying is on out of the money options, you can be right about the direction, but if this implied volatility goes against you, or if theta is working against you, the value of your option can go down even if the stock price moves in the direction that you want it to. If you don't get that, review, rewind, that's important to know. But the cool thing is we have these charts, and if you want to buy an option, you can look at, is implied volatility high? What means high? Well, it's higher than it usually is. Let me go back to this chart. 25 looks to be about the midline. Half the time implied volatility is over 25, about half the time it's below. So if I want to buy an option, I'm going to want the yellow line below the blue line, or the yellow line below 25. And 25 is because it's the midline. Here, this stock we're looking at is Apple. Tesla will have a different one. SPY will have a different one. Amazon will have its own one. So just figure out whatever the midline is. If IV is high, good time to sell. If IV is low, good time to buy. All right. Intrinsic versus extrinsic value means that if your stock, let's see, extrinsic value is the hope part of your option being worth something. So if your option is way out of the money, the value of your option is mostly that at some day we hope it will be worth something. So the hope that it might be worth something means it's not worth anything right now, but we hope it someday that it will be worth something. Therefore, the amount of time you have and the volatility of the underlying stock price will dominate the value of that option. So if you have an out of the money option, you're paying very close attention to theta and Vega, or technically theta and implied volatility. If you have an option that is deep in the money, it has intrinsic value. It's worth something. You can exercise that put. You can sell the put for a profit. You can use that call. It's worth something. And in that case, delta tends to dominate the value of your option. So if the stock price is moving in your direction and you have an option that is in the money, you should note that the value of your option will typically move predictably with the price of the stock. If you have an option that is out of the money, it may not move in proportion with the value of the stock. It may be paying attention more to theta and implied volatility. Okay, whose brains are full? My mouth is tired. um, as you are pulling up your option chain, you want to turn on. You definitely want your bid and your ask to know what you're buying and selling at. The midpoint is about halfway. Well, it's not about. The midpoint is halfway between the bid and the ask. Delta, Vega, and Theta, you all want on your option chain. So you can put these into the math. And open interest is another thing you want to look at. So open interest has to do with how many contracts there are out there right now at that strike price for that option for that stock. The open interest, if there's a lot of open interest, you will generally have a smaller bid-ask spread, and you are much more likely to get filled. Typically, one way to explain that is that the market maker has less risk. If there's 3,000 contracts out there for a call and I want to buy or sell one, there's a pretty good chance that the market maker can match me with someone who has taken the other side of that. Therefore, the market maker does not need to take the other side of that. So what I want you to remember is open interest is good, low open interest is bad. Now, I've said it before that you can sometimes get filled better than the bid, or if you're if you're buying, get filled better than the ask. The midpoint is pretty much the best deal you're going to get. When I am buying or selling options, I usually look at the midpoint and I take off just a tiny bit and I do a limit order. So if I want to sell an option and the midpoint is, say, $1.50, I might put a limit at a dollar. Gosh, my mind's gone. $1.40, right? A little bit lower than the midpoint. And if I'm going to buy, I will buy at the ask. I might put my price at $1.60, just a tiny bit above the midpoint. And almost always I get filled immediately. So a few pennies on your bid and your ask can come up to big time rewards down the road. Okay, open interest. A lot of open interest, good. Small open interest, bad. I know a trader that bought a call on a stock, and the stock price went bullish for a long time, really, really fast. And she held on to her calls for a very, very, very long time. And she said, hey, it's time to sell. And she put in her sell order and she couldn't sell it for about a week. She could not sell the call that would have made her a massive amount of money. So she said, hey, what's going on? And we pulled up the option chain. Guess what? There for a bunch of strike prices, open interest was 0.00000, and then we see her down there at 2. She was the entire market, and she could not sell her call. And her strike price was so expensive, she didn't have enough cash to buy the calls. So what is she going to do? She can't exercise the call, and she can't sell it. She was stuck. So we told her to, hey, call your broker, and they have I forget what it's called, but basically the broker lends her the money, buys the shares, turns around, sells the shares immediately, pays the money back to the broker, and gives her her profits. But you better believe that they charge a commission for that. All right. That's it with Greeks and open interest. If you got questions, type them into the chat pane. I do have it pulled up on this other computer over here. We're going to get into strategy number 1, selling insurance. But before we get into selling insurance, I want you to think about how insurance works on your house. Let's say you call up State Farm and you say, hey, I want to buy insurance on my house. State Farm sells you a policy and you pay them money. And if your house burns down, you expect them to replace it. Well, State Farm's no dummy. That costs a lot of money. They're going to go buy and they're going to, in turn, buy something called reinsurance, or think of it as a wholesale policy. So if your house burns down, or if your car, you get into a wreck, have you ever noticed it sometimes takes bad insurance companies 30 days, 60 days, sometimes even 90 days for them to get you a check? It's because they're getting money from their wholesaler, and they usually don't pay out until they collect money from their wholesaler. But realize that they sell you a policy, then they go buy a policy, and they're on the hook for the difference, but they get to keep the difference in the premium. This is what we are going to do. Now, as we've discussed last week and a little bit this time, if someone wants to buy insurance on their stocks, they're going to buy a put. So therefore, we are going to sell them a put. We're going to sell a put. Now, the insurance company gets a wholesale insurance policy to cover them if something happens. So we are going to do the same. We're going to buy an insurance policy a little bit lower down. So we're going to buy a put at a lower strike. We're going to sell a put, and then we're going to buy a put right below it. So if the stock does go down and we have to buy someone's shares that we didn't want, we have a put that we can then dump our shares that we didn't want onto some other poor schmuck, and they have to take the shares. So we are not intending to collect the shares. Guess what? The broker knows that we are not intending to take the shares. And so the margin that your broker holds is only for the difference. So if we sell at 100 strike and we buy a put at the 99 strike, we're only on the hook for $1 per share. Each contract is 100 shares. So our broker is only going to withhold $100 of buying power. But realize if you if your short option gets filled, you're on the hook for $10,000, 100 shares at $100. So if the stock stays above your short strike, you keep all the profit. So what people like about credit spreads is the stock can go sideways, it can go up, it can go down a little bit, and you still keep your profit. This is how insurance companies work, and you are acting as an insurance company for stocks. Now, if the stock does crater and it goes below your put, your long put, your loss is capped. If it expires between the put that you own and the put that you sold, you will get put the shares, because at expiration, if the stock price is below your short put, you will be forced to buy 100 shares per option at the price of your short put. And your long put is worthless. Do not let this happen. I repeat, do not allow a stock, do not let a credit spread to expire with the stock between your strikes. Don't do that. So again, you're going to sell a higher put, you're going to buy a lower put. I typically do them at the same time. If you want it to be a bull put spread, is when you want to sell insurance when you think the stock is going to go up or sideways. You do receive a net credit for this. You receive a premium. Here are the rules that you want to set up in your trading plan. Use these rules or more. Check earnings whispers to verify the next earnings date is after the expiration of the options that you sell. So Earnings Whisper is a neat little website. Where's the chat pane? Oh, that's this button. It's a neat little website that you can check the next earnings. You just type in the ticker there. So let's say I want to know Apple. It pulls it up. Come on, go faster. And it's going to tell me, where is it? We require cookies for certain features, but I have it blocked. All right, you may have to log in. It's a free account, but it should appear right in here when the next earnings date is. Don't you love doing live webinars and checking things live? All right, we put the link in the chat pane. If you're watching this video, it will be in the description. But for whatever reason, you do not want to hold a credit spread over earnings, because earnings can be a volatile event and it can cause you to lose a lot of money really fast. When I'm doing a bull put spread, I require there to be two supports between the current price action and my short put. I want a delta of 0.1 or smaller because I want a 10% chance or less of my put being in the money. Typically, I look for 6%, but never more than 10%. Never, ever, ever. And always 1 month or less. Sometimes I do them weekly. Sometimes I do 2 or 3 weeks. Find whatever works for you, but definitely no longer than 1 month. Okay. 1 month or less to expiration, a delta of negative 0.10 or smaller. And I like doing these on down days because I get better premium. And if I don't want the better premium, I get my bull put spread further away from the current price action. All right, exit rules. If the delta gets up to negative 0.3, I have been wrong and I want to exit at a loss. Okay, that means I have a 30% chance, not a 10% chance. That's too much. I want out. Or if I see a strong bearish reversal pattern. So if the stock is going up and I see a really strong head and shoulders, double top, it goes up to resistance and I see a shooting star candle, I'm likely to exit early because that's probably a signal that this is the cheapest it will be for me to buy my spread back. All right, protect capital. One max loss on one of these spreads can wipe out many profitable credit spreads. You know how I talk about asymmetric risk reward? This credit spread strategy does not have asymmetric risk reward. The downside is significantly bigger than the potential upside. However, there's a very low probability, how low? The delta low, that I would take a max loss. All right, it's fun to calculate the annualized return on a credit spread. That's the formula. Here's a cool chart. If my credit that I receive is 4 cents and my maximum risk is 96 cents, by the way, someone type in a ticker in the chat pane. You pick, I'll do a credit spread on your ticker. If the credit received is 4 cents, and let's say there was a $1 risk, remember, I keep this 4 cents no matter what. So that means my maximum risk is not $1, but 96 cents. And if the monthly cycle, days to expiration is 30 days, then you do the math. That's a 51% annualized return. It's a 51% annualized return. So if I did this thing 12 times in a year and I received 4 cents times 12, that's 48 cents. That's about 50%. I could grow my account by 50% if I was all in. Okay, this is a really powerful strategy if you don't lose. And that's the real kicker. All right, let's go have some fun. BAC. We're going to do Sam's first. All right, so Sam, when I'm looking at this chart, I see earnings is going to occur here on July 14. I would check that with Earnings Whisper. because I believe the July monthly option expires July 18. I see I have a support here at about 50, yeah, 51 and change. That's about 50 and a half. I have a second support here at 49 point something. So if I can sell the 49, I will. I would much rather get way down here below 46. Let's go take a look at the option chain. Waiting for data. Great, it's after hours. All right, I'm going to pause the recording while we wait for this to come up. Okay. All right, so we got our option chain here. And for some reason, this option expires on July 17th. Usually it's the third Friday of the month for the monthlies, but that's a Thursday. But remember, that is after earnings. I do not want to trade over earnings, but it's going to look really cool. Because if I find, look, this delta here is negative 0.08. So I could sell the 47 strike, and that is way down there where we wanted it, and receive, let's see, I would receive 24 cents. And if I bought the 46 strike put, one below it, I would receive 20 cents. So that's 4 cents. That's a pretty good spread. But it's over options. And you know what? I'm looking at this. I would get filled at 5 cents on that spread. But it's over earnings. I'm not doing it. I'm going to pull open the July 10th. And I'm looking for, where did I say I wanted to be under? I really want to be down at the 46, but no more, or the 49 or 46. So if I traded the 49, that's got to strike at negative 0.10. We're after hours right now, so I would have to sell the 49 strike at 21 cents and buy the 48 strike at 21 cents. There's nothing there. But I can look at the mark over here and see the difference between 0.24 and 0.18. I could receive 6 cents for that bull put spread. My risk would be a 10% chance of that becoming in the money. I would probably do a lower one. Let's go check a look at this 46 strike. I really like that one. I would only get 2 cents of premium. That's probably not going to give me as much of a return as I want. But look, I could do the 48 to 47 and get 5 cents. That's the one I'm doing. I've got a little bit lower risk. My delta is negative 0.08, and I would get 5 cents. That's a pretty hefty premium. And basically, where's my drawing tools? What that says is, as long as the stock stays above 48, I would not be losing anything. So I would sell the 48 strike put. I would buy the 47 strike put for a limit 5 cent credit. And basically whatever 0.05 divided by 95, 95 cents is times 365 divided by the number of days till expiration would be my percent reward, my annualized reward. And yeah, that would be upwards of 50%. I like it. And if I saw this thing come down, probably around in here, maybe below all those moving averages, it's where I think the delta would get to negative 0.3. But if that delta ever got to negative 0.3, I am out. If I see this thing run higher and then give me like a really strong head and shoulders, I'm probably exiting early. I believe my credit spread would be pretty close to zero, so I could buy it back for super cheap. All right, I'm going to go long to show another example just for kicks. All right. Ooh, it's a down day. I would expect my premium to be a lot higher on Tesla, but I am Sam, if you got any questions on that Bank of America credit spread, type it in. Um, Earnings are 722, so that would be after the monthly. So I see a support there. I see a support there. I would really like to be down in this range. So I'm going to bring this on my chart. I, ugh, I definitely want to be under 340, 337. That's a nasty head and shoulders. That is a perfect example of a head and shoulders. Bijan, if you're in this one, it's going bearish. You could buy puts, although puts are going to be expensive if you're waiting till now because of those two big bearish days. Let's see if I can get all the way down here below a 270. What's the low of that candle? 273. All right, so 270. I want a 270 credit spread because I got lots of supports between me and having to, pay money out of my pocket. Trade. Tesla, July 10th. Nope, I want the 17th. One reason I want the monthlies is that my open interest is a lot bigger. Take a look at all of this open interest here. And pretty much I'm going to say anything that is triple digits is good. If I come down here to the 10-cent note, wow, lots of zeros and single digits. So Sam, on that previous one, I did not check open interest. I should have. Make sure it's triple digits. It'll be bigger when the market's open by a little bit. But notice how small open interest is here on the weekly. When I go to the monthly, it gets nice and big. All right. Bijan, I said I wanted to be below 270, right? 270 delta negative 0.04. That is below my, that is below the minimum of 0.10 or the maximum delta of negative 0.1. My spread here, I would be buying the 270 and selling the 265. If I get filled at the mark, that would be a difference of 13 cents. So I'm going to not pull up my calculator. I'm going to get the calculator on my cell phone and say 13-cent credit would be 0.13 divided by the maximum loss I would be taking would be $5 except for the credit. So that's going to be 4.87. Oops. I did this wrong. Okay, 0.13 divided by 4.87 is 0.026. Now I could do I'll go ahead and do it your way. Times 365 divided by 37 days till expiration. And I got a 26% annualized return. Not bad. I'm probably not doing that one. The reason I'm not doing that one is that is a very clear signal that this thing is going bearish. And I want much further down. Let me take a look at more time. Yeah, I don't think that's enough protection for me. I would want to be much further. To be placing my credit spread right around in here, I would want a bigger premium for that. Look at how fast that thing is going down. If that continues, I think there's just too much of an opportunity for it to get down to 270 before earnings. So if it continues at this speed, it would be close. It would be close. Now, I'm going to talk about something in a little bit, and I'm going to jump ahead and do it now because this may be a really great example. Bijan, did you do this on purpose? All right. I see this thing going bearish. I could do something called a bull call spread. It's the same thing as the bull put spread, but in the opposite direction. I'm going to sell a call and then buy another one as insurance. So I'm going to play insurance person for people that are in this thing bearish. Yeah, see all the big red bars there. A lot of people got in bearish there as it closed below the neckline of this double top. Kablamo! I don't think I'm going to get good premium because it's on a down day, but let's check it out. I have resistance 1, resistance 2. That's kind of resistance 3. That's certainly resistance 4. It tells me very clearly the high there is 498.83. I'm going to see if I can do a bull call spread up here at 500. So I'm going to sell the 500. I'm going to buy the 505 expiring before earnings. Yeah, earnings is on the 22nd. All righty. Let's go back into this option chain, and I'm going to come over here to the call side. And I said 500 here. The delta on that is 0.08, so that meets my criteria of less than 0.10. I would be selling the 500 and buying the 505. That's going to give me, what's 0.28 minus 0.115? That's going to be 16.5 cents. I don't think that's going to be enough to get my interest on this, but I'm pulling out my calculator. So pull out your calculator or pause the video and punch the numbers in with me. 0.16. Yeah, I don't think they'll do half a cent on the premium. All right, 16 cents premium. I got a $5 risk between the two, but I keep my 16 cents no matter what. So 16 divided by 4.84, because that is $5 minus 16 cents. That gives me 0.033. Now, I'll tell y'all when I'm doing this, just in my head, I'm going to multiply by 12 and say that's about a 38% annualized rate of return. That's how I spitball it because it's monthly. But it'll be, let's go ahead and do the full math. Multiply by 365 and divide by the number of days remaining, which is 37. Well, that gives me a 33% annualized rate of return. So a little bit lower than I guesstimated spitballed. I haven't studied Tesla stock enough recently to do that, but if I was going to do a credit spread on Tesla, I would be taking the bear call side. You know what? I'm going to jump ahead just while I'm here. What if I had reason to believe that this thing's been pretty volatile? I think it's going to go sideways. Bijan and Sam, what is the chance that on expiration, which is going to be about here, that the price of the stock is both, okay? Oop, let me change my picture a little bit more. What is the chance that the price of Tesla will be both below 270 and above 500 on expiration day? What is the chance that it is both down here and up there on July 17th? Bijan says 0. That's exactly right. The stock price will not be both above and below at the same time. So the market maker knows what you're doing, and they will only withhold your buying power for one of those. So one of those was a 26% annualized rate of return. The other one was a 33%. The other one was a 33% annualized rate of return. Guess what? If you do both of those, you can do both of those at the same time, and it's a 59% annualized rate of return. You can get in both sides. And when you do, it's called an iron condor. So one thing you could do is maybe get in one side, and let's say this thing comes down here and it starts to go back up. Well, then you get into the other side. You would get less time and you would get less premium, but you can leg into each side. When you get into each side, it's called an iron condor, and that's fun. Questions on credit spreads, type it in the chat pane. I'm going to go back to my slides and move a little bit more quickly. All right, do not do these over earnings because you can get a max loss immediately if it jumps over earnings. Oh, one thing this thing points out, and I'm glad AI wrote this. Implied volatility spikes before earnings. Remember, we talked about that. Therefore, the premiums look really attractive. The premiums get much higher for your credit spreads. So if you're doing a credit spread or looking at one and the premiums look too good to be true, check earnings. All right. One max loss can wipe out 24 wins in a row. If you're doing this monthly, that means one max loss wipes out 2 years of wins. Do not take a max loss. All right, this is going into bear call spread. It's basically the same thing, just going the other way. You sell a call and then you buy a call at a strike higher. Again, go to earnings whispers, check the earnings date, never hold over credit spreads. You want the short call to be less than 0.1 delta. I want 2 resistances between my short call strike and the current price action. 1 month or less to expiration. And I guess I was looking at options that expired in 37 days and on Tesla, and the math was just kind of so-so. So I might check the weeklies and see if I can get the math to look better. Maybe I didn't like the math because theta was too big. And if I chose a shorter shorter timeline, a option that's going to expire sooner, then the math may have looked better. All right, exit when the delta crosses 0.3. Don't take a max loss. The math is the same. When you do both sides, it's called an iron condor. And yeah, these returns get really, really, really good. All right, pause the video, go back, because I did go through those slowly, if you have questions. Pressing on, it's getting late. This is going long, but I want to get this in because some of us are going to a stock trading strategy on seminar, on Friday, and knowledge of these Greeks and certainly knowledge of credit spreads and iron condors will be taught. So I want you to hear my perspective, and then you'll hear their perspective, and we'll get to practice, and you can write your own rules. All right, a strangle is when you place a call and a put at the same time out of the money. So you're going to be down here at about the 0.25 delta for call and the delta for a negative 0.25 for your put. If the stock goes up, your call is going to increase in value very quickly, and your put is going to decrease in price very slowly. So the net is you will have a win. And likewise, if you buy the call and the put and the stock price goes down, your call is going to go down in value very slowly, but your put will go up in value very quickly. And again, you have a win. Now, what's really cool, if you have these, is you buy both, and let's say the stock goes down. Well, your put goes up in value quickly, and you sell it. And then the stock reverses, and it goes up. And suddenly your call goes up. And guess what? You win on both sides. Woohoo for you. I'll tell you, I don't do many strangles anymore. They are fun, but they take a long time, and I haven't exactly killed it. All right. You buy a call or put at the same time, out of the money on each side, opposing deltas or neutral deltas. Get as close to zero as you can when you add your two deltas. That's important because whichever one is right, you want to gain money quickly and you want the other one to lose money slowly, but at about the same rate. So you need to buy them at neutral deltas. Whichever side wins will gain money fast. Whichever side loses will lose money slowly. You want a big move in either direction. You don't care which. You want to buy them when implied volatility is low because you are buying out of the money options. And when you are buying out of the money options, Vega and Theta rule the value of your option. So buy when implied volatility is low, because that means that when you go to sell, there's a better chance that implied volatility is the same or higher, which helps the value of your options. Definitely get in before implied volatility goes up, before earnings, right? We looked at that a while ago. Before earnings, implied volatility goes up. Before earnings, implied volatility goes up. So buy before that implied volatility goes up, which is why I'm sharing this chart with you. I like to buy enough time that it spans 2 to 3 earnings announcements. That gives me several chances to win. It also gives me the opportunity on one side to win and then hold the other side. All right. When the stock makes a big move one direction, sell that option for a profit, lock it in. And then the other option, that if it goes in the other direction, is just pure extra fun. Okay. If you hear of a strategy called a straddle, that's when you buy and the put at the money. That becomes very, very expensive, and your returns are not as good as if you buy them out of the money. It is safer, but returns are lower. All right, so one wins quickly, the other loses slowly. And hopefully you can get the other side as well. All right, so the math, how does it work? You got theta decaying. Theta is working against you. So you hope that the upward move in delta and hopefully upward move in implied volatility is going to help you more than the theta drags you down. So what's the math? You take your delta and you multiply it by the average move on earnings. That means you got to come over to your stock chart and you got to look at how much did it move over earnings. Tesla didn't move much of any over earnings, didn't move much of any over earnings, didn't move much of any over earning. I'm probably not doing a strangle on Tesla. Let's take a look at Bank of America. If y'all have one that jumps big over earnings, share it with me. Ooh, maybe Bank of America is the one. So I see this big gap here over earnings. I'm going to look at what that price was, what that price is, and make a note that's the gap over earnings. Got a big gap here. This time it gapped down. I'd make a note of where it closed on that day and where it opened that day and call that the move over earnings. I see another big move over earnings here. I see another, didn't move there. It had a gap there. Didn't move much there. So I'm going to take the move over earnings for these 6, and actually I'm going to pick up 2 more. Big move on earnings there. Big move on earnings there. So Bank of America might be a contender. I'm going to take the average of the last 8 earnings announcements, multiply it by delta, probably 0.25, and that's going to be the increase, expected increase in the value of my option as we get to earnings. Now, theta will be decaying my option. Now, if I buy a lot of time, theta, the change in theta will be very slow. So it will be a conservative view if I take theta times the number of days till expiration and subtract it. So that's how much my option will go down in value. The delta is how much it will go up in value. And implied volatility, if I bought it with low implied volatility, that should only be able to work in my favor. If I can beat 2x the price of the call plus the price of the put, I'm going to do it. But again, it's 2 or 3 earnings announcements to double up over half a year. That's the math. Yeah, remember before earnings, implied volatility will go up. So be sure you buy before that. At the announcement, implied volatility will drop like a rock. Be ready for the stock to move in a direction, and the option that you wanted to go up doesn't go up as much as you had expected. It may not go up at all because implied volatility may crush the value of those options. Buy before IV gets elevated. You can check if IV is high or low based on the bar chart. Exit plans. Exit when either the put or the call reaches double what you paid. Sell that one, and you have locked in a nice win. Keep the other option and see if it could become a value later. If you're holding one of these puts or calls for a winner, realize that the next earnings announcement can wipe out some gains. So if you need to exit early, you can. All right. Questions, comments? I guess we could go look at a strangle, but there's kind of a lot of math to it. And everyone that's here live, we can look at those at a later date if you see one that you like. Why not? Let's just go take a look at BAC. All right. Let's see, that one closed at 50 and that one, oh, I've got it wrong. Let's say that's a $3 move. And let's say that that one is a $4. Let's call it $4. I would measure them all. I'm picking something bigger because I want this to work. So if I'm expecting a $4 move over earnings, 4 times 0.25 is 1. So now I'm going to look out, let's go 9 months. So that means I'm going to be looking at, what is that? April. April of 27. And I want to buy at about 0.25 delta for my put and my call. Looks like I have to choose between 0.19 and 0.30 for the put and either 0.29 or 0.19 for the call. I think I'm going to choose 0.19. It's kind of a toss-up. Really, that 0.3 or 0.2 is a little bit closer, whichever one you want. I'm going to be buying the 70 strike. The 70 strike call expiring April 16 of 2027. And that's going to cost me $1.35. And I'm going to be selling the 45 strike put. And I'll be buying that one too. That's $2. So $2 plus $1.35 is $3.35. Now, Theta. Theta for my option over here is 0.01. So I'm going to lose a penny per day, and I've got 310 days. So that means I'm going to lose $3. That's a problem. If my expected win is $1, but my expected loss is $3, I am out. If I do 0.29 instead, that's still not enough. It could be because I'm looking at after market numbers, or it could be that Bank of America just doesn't move enough over earnings for the math to work. But I'm definitely doing all that math, and I am wanting a 2-to-1 reward risk ratio. So it's got to move a lot over earnings, and right now I'm not seeing that. What else? No questions in the chat pane. I think your mind may be fried as much as my mouth. All right, build your own financial fountain of freedom. Get your mindset right. As you can tell, some of these things are complex. They are hard. They are difficult. Get your mindset ready for hard things. Calculate your desired rate of return. If credit spreads and strangles do not meet your desired rate of return, don't do them. You can get my calculator, our calculator, and calculate what rate of return you need with inflation. I did a special video and I called it episode 3.5. So if you're watching this in the playlist of Financial Fountain of Freedom, go back to episode 3.5. I also talked about it in episode 3 on how to use the calculator, calculate your desired rate of return. Structure a portfolio that is diversified, non-correlated, with asymmetric risk reward on every single investment you do, with the bulk of those investments in real estate. Actual public equities like stocks should be a smaller proportion, 20 to 15% max. Have some energy, some alternatives, some private equity, and surge your need for cash on cash and equity growth. Indomitable horizons, right? Our goal, we don't have it right now, but it's coming, where we build portfolios like this, and we will help you get portfolios that have all of these characteristics for much less than the minimum exists now. That's our goal, right? Is to lower the minimum required to build one of these portfolios. All right. Lots of information here. Remember that 10% of a skill will be acquired by reading, listening, watching videos. 30% will be acquired by discussing it with others, and 60% by doing it. So get yourself around people that are doing this, and preferably that are more skilled than you, and they will bring you up because you are the average of your 5 closest friends. Follow me on social media, send me messages, ask me questions, give me ideas on tickers that you're looking at, and I will give you my thoughts. Sam says, so much to learn. Yes, ma'am. But that's why it's helpful to do this as a team, Sam. So thank you for being on my team. Bijan, thanks for being here. Dad, thanks for being here. Love you. Oh, my dad, bonus for those of you that have not clicked kill it yet. So my dad taught me a call. Remember a call? Because if you sell a call, your shares can be called away. You can be forced to sell your shares to someone else. They can be called away. And if you buy a put allows you to put your shares onto someone else if it's going down. And I should have mentioned this on the short put strategy. My dad loves to sell puts that expire shortly before a stock receives a dividend. So if the short put expires worthless, of course, you receive the premium for the put and you go away a happy camper. If you do get put the shares, which is always a possibility, at least you get a dividend immediately to help lower your cost basis. So if you like that idea, look to sell puts on stocks that pay dividends shortly after expiration day. But remember, there's something called the ex-dividend date, and you need to, I guess, you know what, I'll talk about this next time. But you must be an owner of the stocks before the ex-dividend date. So be sure that after expiration, the stocks have 3 days to settle in your account, and then that ex-dividend date is on the 4th day or more. and then you receive the dividend shortly after getting put the shares. Never sell a put unless you are ready to buy 100 shares and want to buy 100 shares at that strike price. Okay, I'm tired. I'm going to bed. You guys rock. Hit me up on social media. Give me a follow. Ask me questions. And as always, trade on logic, not on hope. God bless you.